So this is Deconstructing the Blockchain Ecosystem. So for everyone who's gotten into it, I don't know how deep you guys are at this point, but it's always a bit of a trial trying to find your way into this ecosystem. I remember distinctly what it was like for me doing my research, and it was like a tire fire where you're sort of descending through the oily layers of smoke and misinformation to try and find where's the signal among the noise, and how do you figure out what matters, what's real, what's not. And from all that, like you have to sort of descend through the smoke, and then you have to figure out who do you listen to, and then from that you have to start building a picture of what this ecosystem is, and then you can start figuring out what are the problems that you're supposed to solve. So what I'm hoping to do here is shorten that path a little bit for you. So one of the analogies that a lot of people use is sort of the 5 stages of grief. Is a pretty good one for getting into the space. You kind of start with abject denial, then you get really angry that everybody else is doing this, and why does this even exist? I've been through every single one of these over the last couple of years. Then there was definitely the bargaining phase, which is like, this is only good for a few things. And obviously then you get depressed when you start seeing that all the idiots are getting rich. and finally there's acceptance that actually this is maybe a viable technology, and it's something that some of the smartest people in the world are working on. And that's hopefully, if you're not there, I encourage you to find your way there, and hopefully this can be helpful. And if you are there, then hopefully this can be helpful as well. So like I said, once you've kind of descended and you've actually gotten to the point where you believe in this, you have to get your bearings. You have to figure out, what is here? Where did we arrive? And where can I fit in? And so again, I think a lot of the context that we get is very much focused around starting from the technology and trying to educate you about why blockchain is a multi-layered series of cryptographic things that represent XYZ, right? And like that's maybe not as interesting for a lot of people to try and figure out at a much more basic level, like what's actually going on here, and how can I be a part of it? So that's basically my goal here, is to try and short circuit that. So I think we all know the feeling. If you've started to explore the space, the news comes in faster than you can absorb it. So information throttling is definitely a really strong personal asset to have. So, but it's a lot of fun. And so again, what I want to talk about today is not the technology itself. So I mean, I'll kind of touch on the edges of the technology, but you're not going to see any of these like this is what blockchain is diagrams. You can find those pretty much anywhere. So today is much more about what goes on around the technology. And they also say that you typically age in dog years in the space because of how fast the information comes, but it's also a lot of fun. So just a quick bit about me. I head operations at Near. Near is a mobile-first scalable blockchain, so it uses sharding. That's layer 1 sharding solution. You may have an idea of what that means, you may not. But we have a team of the essentially Russian rocket scientists out there building this. They've built sharded databases before, and this is a problem that I deeply care about. I'm very interested. My background is sort of straddles this weird blend of Wall Street and then online education in the software space. And it's funny how this kind of draws from actually absolutely every single piece of this. But so what I want to cover today is basically 5 things. Just kind of take a quick walk through what the future might look like and some of the macro trends that define it. Take a look back in time at some of the historical narratives, more focusing on the narrative than on the history, because the narrative tends to drive us far more than the actual fact underneath it. Finally, or then moving into the use cases, talk about where we are in adoption, and then naturally from that, what are the problems that we're facing, and then ultimately, what does that mean for how you can actually begin to step into this? So kicking things off with the vision, two giant super trends that I think are well worth paying attention to are the fact that everything's becoming data. I think you guys are probably all well aware of the idea software is eating the world, but this keeps going, and it's more than just software eating the world. It's everything is becoming data, and we are digitizing and datatizing just about everything. And on the flip side, the people who control the data, or the entities that control that data, are getting more and more power in the global system. So one of the things that's becoming data is money. So when we got started, we bartered. Then we went and we had coinage. And coinage moved into banking, where we were storing it in a vault, and we got an IOU for the exact amount of coinage that we put in there. And then central banks started making up money out of thin air, and that was fiat. And then we stopped even bothering to actually issue money at all, and we put money in the cloud. And so now we just trust that money going between accounts is out there somewhere. And really all it is ones and zeros. And we have to trust that that exists. Assets are also becoming data, right? So once upon a time, if you could defend it, you own it. Then we moved into physical titling. We began aggregating digitized goods. So things like real estates, you're able to pool these all together, securitize them, sell them off. And now today, we're actually, instead of the aggregation of digital goods, we're actually moving back into the disaggregation, specifically chopping things up into tokens. But again, everything is starting to become data. And of course, you are also now data. Sadly. Once upon a time, we had total anonymity. For a brief period of time, there was data, but it was forgotten. But everything you do has a vapor trail, which I think we're all well aware of, but also you are a data point, and you're a data point that gets passed around constantly. Every single thing you do gets tied back to these identities that companies have created for you behind the scenes, whether it's Facebook or an advertising platform or a healthcare company. Everybody is passing you around behind the scenes. So you are also data. And this is important because who controls the data controls the system. So again, once upon a time, data used to disappear, and that was wonderful, and we could get away with things. Right now, we're in a phase where data is hoarded, and because people realize that you can extract value from that data. And of course, so right now, corporations are basically using that. You apply machine learning, or you use analytics. I mean, you can use it across all number of things. I think we're all well aware of where that goes. But ultimately, it means that they're able to build better products, but those products come with moats, and those moats come with rent. And that means that ultimately, it's a great rise up, but once you're locked into a system and you can't leave it and you want to leave it, that's a problem. And among other problems, which is of course that once you've centralized that data, it becomes a tool for hackers, a target for hackers. It becomes a target for governments, and it becomes an asset that companies can sell off. So, I don't want to stand on a soapbox, but I mean it is obviously relevant to all of our lives and the world that we live in. That this is what occurs. And what we're hoping to move towards is individual control of data. So this is one of the things that blockchain allows, which is quite interesting, is that we begin to re-decentralize data and allow you to maintain control of it. And so that I think is an important super trend that we're hoping to continue forward, but we'll see. And again, just a quick illustration of if you control the data, you control the world. In 2001, there was one tech company in the top 5, and now in 2016 there are 5 tech companies in the top 5 largest companies. I think we all know that, but it's telling to see that and to see the value that gets placed on the way that they're operating their gatekeeping. So we kind of have 2 visions for the future. I mean, I'd say the default future is future 1, which is where we are, which is, as a company, what you should try to do is find as much data as possible, hoard that data, and monetize it. And future 2 is there a future where we can re-decentralize that data, give the power back to the people, and ultimately, will that actually open up new paths that are ultimately better? And I think everybody has an opinion about kind of where that goes, and I'm more just going to take a step back and just say, future 1 might be a local maxima, whereas future 2 is a global maxima, and it's a tough journey to get there, but we have to get there. That's not a given. I think we can all agree that we're early enough in this space that we don't actually know. We don't actually know if this is if that is in fact a better world or if it's not. But I think we're all confident enough to put our time into it and actually try to get there. And obviously, it's a bumpy road. We're in a lot of ways we're fighting people's natural tendencies to want to give their data to centralized entities, right? Do you really want the responsibility for controlling things? I mean, the more things I have, the more things I lose. So this is a really important set of forces. There are a lot of user experience related reasons why it's actually a good thing to centralize a lot of data. And so the only way that we can actually succeed is if we create some individual incentives that make it more worth your while to control this than it is to give it up. And that's sort of a fundamental thing. Or also, if we're fed up as a collective enough that we can vote through sort of the aggregate systems that we have, like systems of control, like governments, and give them the tools to implement things like, say, GDPR in Europe, which was more or less we're fed up with being monetized and advertised at and not have control of our data, and they were able to pass that, which again, pros and cons, but in aggregate, what it says is people are able to actually exercise their collective will through law. We need one of those two mechanisms to actually become compelling enough that people take a step forward. Otherwise, it's just not going to happen. We can't tell people day in and day out, this is good for you, eat your vitamins, if they don't actually have a short-term incentive to do that. So one of the fundamental searches that we have in this space is looking for these incentives. How do we create new models, new interactions that show people that this is valuable and give them new ways of making this valuable for them in the short term. So I think this is kind of the fun part, historical narratives. So obviously the best way to get context for where you are is to know where you've been, and this is a little bit different than your average history, just because I'm not going to walk through the dates of what led up to the Bitcoin white paper. I think you can find that online. What I want to highlight is that actually it's a convergence. It's not the convergence of a single thread. It's convergence of a whole ton of different threads that all come together. So one of them is the cypherpunks movement. Freeing cryptography from the government. The government used to actually regulate the export of cryptography. That's not the only thing they stand for, but it was an important step forward. You had obviously the digital money movement was a major factor. People for decades and decades and decades since there were computers were trying to invent digital money. You have the open and closed internet paradigm, which I'm actually gonna talk about in a sec. You have open source, which has been constantly struggling for a business model. I mean, open source software is phenomenal, but the mechanisms by which it's produced still are really problematic for developers and also for the maintenance of that software. So it's definitely not the optimal way to develop systems. It just happens to be the way systems have been developed. You also have social trends, like I was saying with GDPR. You have the beginnings of movements that are getting bigger around turning against data hoarding, against the sort of the governmental use of data and everything on that side. And then finally, I think another useful one is peer-to-peer. The file sharing movement was actually hugely influential in a lot of what's gone on into this space, because a lot of the protocols that emerged from the peer-to-peer file sharing movement actually informed or actually are effectively being used in the blockchain world. And I think specifically the fact that file sharing could not be killed is a very interesting thing to keep in mind, because you can see the same things in Bitcoin, which is, despite every effort, whether internal or external, intentional or unintentional, it just continued to persist. And that's actually a really useful set of lessons. So I encourage you, John Backus put out a really interesting set of articles on Medium about the peer-to-peer file sharing history. So I'm not going to dive into that specifically, but it's actually a really good read. Where he kind of walks through the history of file sharing and kind of how the protocols developed, and it was all about staying half a step ahead of what was going to shut down those protocols, and it wasn't they didn't go out there to be decentralized. They were forced to be decentralized because everybody kept the lawyers and governments were playing whack-a-mole, and the only way for them not to get whacked was to decentralize. And so it's kind of an interesting progression that's gone through that, where I think one of the key takeaways is, in fact, that decentralization is not an end. It's more of a side effect of trying to avoid other things. So the one I wanted to highlight, which is kind of interesting, this is actually something that I heard first from Benedict Evans from A16Z, his talks online are really great. They're really useful for everything from consumer trends to AI-driven research to blockchain stuff. He basically, I think he just gets paid to be smart and give talks. Luckily, he's good at it. Basically, the theory here is of course that in the early 90s we had closed networks. The way you got into the internet was at best through AOL, and then in the late 90s we opened up those internets, and that was the heyday of the decentralized web, and where you had permissionless innovation, which was of course a phrase that we've all heard, and is a super important thing for enabling aggregate creativity to emerge. Sort of the emergent property of aggregated creativity is innovation as opposed to top-down innovation. But then, of course, in the late 2000s, we had the re-centralization through gatekeepers, through aggregators like Googles and Facebooks and platforms, and then walled gardens through smartphones kind of sealed the lid on a lot of things because, of course, the Apple Store, the Play Store, things like that are hugely influential gateways for accessing the web and pretty much all of the features of it. But then the question is, are we cycling back into an open paradigm? Because we have the potential to be in an open paradigm, because a lot of what we're looking at in the new web is reopening, re-decentralizing. Again, the key question is, can we get there, and is there enough incentive to get there? But that's the possibility, is that pendulum comes back out again, or that aperture opens back out. All right, so now we're into the details. You guys are well familiar. 2008 Bitcoin. Bitcoin still is the champ. I mean, by market cap. I don't know what its dominance technically is. I don't know if you guys track the market directly. Maybe you have a quote from today, but it's, it is still the number one, and for the foreseeable future, it will be. It also has been driven by a bunch of narratives, though, because of course, when Bitcoin first started, it was an e-cash thing, right? It was sort of digital money as a proof of concept. And I didn't make up this, by the way. Nick Carter had a really great post where he went into this. And so it's Bitcoin has all these different narratives. It's been e-cash. It's been a peer-to-peer payment network. It's been digital gold that's censorship resistant. It's been used in the darknet. It's been used as a reserve currency for crypto. It's been used as a programmable database, and finally as an uncorrelated financial asset. And you don't need to read the details of this, but I mean, this was the image that he used in that post to kind of illustrate the progression of the narratives. It doesn't really matter which one is which, to be honest. I think for me, my point is more about the generalization of narratives and the fact that they change over time. And that Bitcoin, the blue here is the eCash proof of concept, which obviously started out great and has sort of petered down into nothing. Whereas on the other side, you have uncorrelated financial assets are starting to come in as institutional players are beginning to look at the space. But it's been interesting to track this over time and to see, how well, Bitcoin is, everybody's gonna pay for everything with Bitcoin. Oh wait, that's too slow and too expensive. Okay, well, so, it's more like gold, and we'll store value off to the side. And so I think that's an interesting thing that sort of informs both context and hopefully a healthy skepticism for anything you read today where people have it figured out. These narratives take years to progress, but they all kind of run their course, and we don't know which one is going to win. And obviously, not necessarily one is going to win, because you have a market when multiple people have different ideas of what's going on. So in 2013, we had the rise of the currency coins, and so those were the coins that were specifically modeling themselves off of some of the properties of Bitcoin that they wanted to emulate. So you had Litecoin, Ripple, and Dogecoin all kind of got started in 2013. Ripple is a little bit of a special case. You had Monero, you had Dash, Zcash. This was kind of the early innovation. Again, you don't need to really understand like the details of which one is which. This is a price chart that shows Bitcoin coming out and kind of when we started tracking prices for these different currencies. So kind of the first thing was like, oh well, Bitcoin is starting to actually work. So we're going to sort of copy it and make it a little bit better for the use case that we want, whether it's privacy with Monero and Zcash, or Litecoin is basically just copying it. Dogecoin, why the hell not? and that was kind of the next iteration, attempting to kind of move beyond Bitcoin, or at least replace Bitcoin. One of the key problems is, of course, like, how do you actually value a currency? So one of the struggles that we've had in the space has actually been around the valuation of these things. Because what does it mean if Bitcoin's worth $1,000 or Bitcoin's worth $100,000? Like, nobody really has this figured out. All they can really do is start to walk backwards, do the math, and say, okay, wait, so what's the total addressable market of money? So if we create a currency, what is that even worth? So you could start with, well, remittances are about $400 billion a year. That's a pretty chunky market. So if we can capture X portion of the remittances market in the value of our token, and it's a currency, maybe that gives us some percentage of that. Or you could start walking up the US money supply, or you could go up to the global money supply, which is $90 trillion. So, does that mean that if you create a new currency that actually becomes digital gold, or digital, let's say the world's reserve currency, that now it has a $90 trillion addressable market? I don't know. That's hard to say. But these are some of the problems with what's created the space and made it the way it is there's so much failure to understand how to actually create an exact model around what it actually is worth. So we move into Ethereum, obviously. So Ethereum comes around in 2014, and that basically becomes the rise of the smart contract platforms. It's a super innovative, interesting idea. Bitcoin allowed you to program certain pieces of what it was doing. It was kind of like having an addition calculator, plus minus divide sort of calculator. And so what Vitalik and crew came out with was, well, so what if instead of having an addition calculator, we actually just built a computer that was using the same type of technology? And so that was where Ethereum came from. And that kicked off this idea that, well, so what if we, like, what can we build on top of a computer that runs in the whole world, across the whole world in a decentralized way? And so then you started to see the rise of the smart contract platforms. But still, I mean, all of these things have taken years. So, you know, you had a number of platforms sort of slowly coming out. 2016, I mean, Ethereum Classic isn't even a new platform. It's just a fork when they got pissed off that you know, that the DAO hack got resolved in a certain way. And then finally in 2017, I think there was enough momentum building up where there was enough market interest, there was enough proof of concept that people, you know, a lot more currencies thought they could come out, and, or I say currencies, a lot more projects came out and decided that they could do it better, essentially. And so you saw EOS, IOTA, Tezos, Neo, Cardano, Tron, all sorts of people coming out in the last year or two. And of course, how do we value those? And so again, it's if we don't know how to value it, then it's your guess is as good as mine. It's undefined optimism. And so how do we value a global infrastructure platform that the entire new internet could run on? Like what if the existing internet could actually capture value? Hell if I know. And so, you know, where do you start? I don't know. Global GDP is about $80 trillion. Some random study on the internet said internet drives 6% of US GDP. So maybe we're saying it's $4 trillion that you could actually create and assign to a global infrastructure platform. And then you ask, okay, so what percentage of that could be captured? And you can maybe build a cash flow model based on that. I don't know. I don't think most people did that much homework when they were just buying. So of course we get more to the present, as I think we are all well aware. So the ICO bubble was started because basically anyone can launch a coin on Ethereum, and that was one of the interesting features that I think it took people time to figure out that they could do it too. You know, there were a few things that fed into it, which I'll go into as well. ICOs obviously at the end of last year just completely exploded, and you know they there's a lot you can say about ICOs, but one of the key things is that it was kind of outside of traditional capital formation methods, and so it kind of gave people a shortcut to raising a whole bunch of money. So what do you think they did? Well, here we go. Irrational exuberance. It's time to raise a bunch of money. One interesting bit on the chart on the right is that ICOs aren't actually completely dead. It's close. It's close in the US, and I think they might be sneaking in some data from private offerings, but they're not completely dead yet. They're just getting awfully close. And so what fed the ICO boom? You know, again, how do you value an ICO? How do you capture value? And I think one of the more influential theses was put out by Union Square Ventures, Joel Montenegro, in 2016. And basically the idea was, well, maybe we just flip the paradigm. We say the applications that are built on the internet capture about 90% of the value. You know, the Googles, the Facebooks on top of the internet capture the vast lion's share of value. And the protocols underneath that, they sort of the guts and the pipes capture a very small piece of it. Well, so what if we flip that and say, well, I mean, the whole point of the blockchain is that you're storing the data on the chain, and you're storing the majority of everything on the chain, and the apps themselves are only designed to be thin skins on top of it. So really the protocol is the thing that's capturing all that value. So, you know, the new web is not about apps, it's about protocols. And so once you say that, all the value gets captured in protocols. We don't really know what that looks like, but that gives us an awfully good justification to buy. And so again, you know, valuation models always tie into these narratives, and it always helps drive some of the speculation. And you can never pin anything down to a specific model, but I think it's very instructive to say, and I think that you'll probably get majority agreement that that was one of the most influential models that people were using when justifying some of the irrational exuberance they were using around what was effectively Internet Bubble 2.0 for basically the same reasons. And so, of course, this year the ICO bubble is completely imploded. The ICOs were built on top of Ethereum, which actually helped Ethereum a lot because, of course, you know, your Ethereum was creating tokens on top of it that were then, in theory, all of the transactions from those tokens could sort of trickle down into Ethereum as well. And so people were, I mean, there were a lot of really crazy justifications for what was going on. But Ethereum was sort of, one of the narratives was definitely that Ethereum would capture most of the value of the sum of all the tokens that are built on top of it. So of course Ethereum goes to the moon as well. The problem is, you know, ICOs actually weren't that good. I mean, the tokens that were created on top of Ethereum were almost entirely worthless. You know, show me a token and I'll show you a shitcoin. And so, I mean, a lot of these tokens also had as with any irrationally exuberant market, you had too much money moving too quickly with not enough oversight. So of course we had scams, we had sort of soft scams, which are, you know, teams that kind of know that they aren't really going to do anything, but they're going to make it look like they're doing things. You had genuinely intelligent people who thought they were doing good things, who thought that their token was important, but didn't really think it through. And honestly, most of the coins actually had no value capture. And if you have no value capture, then your token is actually worthless. I'd be happy to talk about the details of that because I've been down that road after this if you guys want to dive into it. But one of the narratives over the last, call it 6 months, was that the big path down and why we keep continuing to go down was this idea that a lot of the ICOs actually raised in Ethereum, in Ether. And so, you know, they were getting people who had become rich on the way up, were reinvesting their Ether in ICOs, who then had these big treasuries filled with Ether, and who were also riding it up. But then when it started going down, they said, oh crap, we raised $20 million, but now it's only $15 million, and what happens if it goes to $10 million? And so they start selling, and there's this narrative that, you know, it's this snowball effect that suddenly all the ICOs that prop this whole market up start selling and dumping it back down. And, you know, there are a number of perspectives on either side. You know, you can find blog posts out there that are sort of debunking the facts of that. But, you know, again, less about facts and more about narratives. I think that's been a pretty dominant narrative over the last, call it 6 months. And then here we are in the bear market. It is a depression. I don't know what you want to call it. But there are advantages to it, and I think also one of the major triggers here has also been the SEC and the regulatory landscape, which this is something that you can't ignore in this space. I mean, we did our best to ignore it as a space by sticking our heads in the sand and saying, well, if we don't call it a security, it's not a security. And the SEC doesn't really like that. It turns out, if it looks like a security and it smells like a security, it might be a security, and they actually have a lot of interest in that. And so one of the more recent updates has been specifically from November. So the SEC began prosecuting some of the scams that were out there, some of the obvious scams, but they've also begun prosecuting securities violations, which is different. Criminal violations are obviously something that, you know, should be prosecuted, and everyone kind of gets that, and they knew that was going to happen. But everyone was waiting to see what they would do with regards to the idea of selling unregistered securities, which is kind of the whole problem with ICOs. Is if your token is a security and you've sold it and not registered, that doesn't work with the SEC. That's the whole point of the SEC, is that you need to register these kinds of things. So now we've crossed over. The SEC has made it clear that they're going to start taking a look at these as unregistered securities, and they're going to begin taking action against founders and companies who have done that. The fines haven't been massive. Generally, it's been sort of a return the money and take a fine and we'll move on. Especially if you've been sort of cooperating, you know, in good faith and everything like that. But that has an awfully chilling effect when, you know, you might have already raised a whole bunch of money, and then the bear market hit, and now you don't have as much money, and now the SEC is going to tell you to return all the money that you originally raised to your investors, and you know that you're sitting on a bankrupt company and it's just waiting for the other shoe to drop. That's not great for a market. So one other thing on regulatory clarity. So again, it's been one of the big chilling factors overall for the whole thing. And so a lot of what happened in the ICO space, I think, was people taking a step forward, sort of swallowing the risk that they knew they were taking on the regulatory side. And now those, I don't know what you would call it, those hens are coming to roost. I don't remember what the expression is, but and some of the key ones were who is actually supposed to regulate this stuff. And this is going to be a U.S. centric view, but the U.S. tends to take a very global regulatory perspective. They tend not to be too shy about stepping outside of the boundaries of the country. So it has a major impact. And so the real question was who is going to regulate it, and are they going to regulate it, and how? And so there are three main entities that tend to be a part of this. The SEC, they deal with new securities issuance. The CFTC deals with commodities that are already out. And the CFPB tends to deal with, the Consumer Financial Protection Bureau tends to deal with money transfers and things like that. And so a lot of the question was, okay, so who is going to regulate this stuff, and what are their models going to be, and how can we conform to those models? Because we still, like, you know, there are still reasons why we want to have tokens, and you know, we have to be able to have tokens if we're going to drive this forward. But you know, that's very difficult if you don't know what if three agencies are all going to come at you for different reasons that make it physically impossible for you to have a token. So there was a little ray of light, actually, which was quite nice from the head of the CFTC, who, of course, it's his job to register commodities. So I mean, you can take this with a bit of a grain of salt. But he did essentially say that you could transform from a security. So it's sort of when it's offered, it's a security. But then your network could actually achieve a certain level of decentralization and utility where it actually becomes a commodity, not a security anymore. And where do we take that? Where does that go? There are a lot of questions that raises, but at least we're moving towards. Okay, so maybe Ethereum was a security when it came out, but we're not going to worry too much about that because now it's not a security. So at least we can trade Ether while assuming that the SEC is not going to get interested in us. At least we can trade Ether and say, well, it might fall under the CFTC, but at least we're sort of narrowing the scope of the people who are going to hang the sort of Damocles over our head. All right, other rays of hopes. So that was a bit of a downer on the end, right? Because here we are in the middle of the bear market. And by the way, I don't know where that image came from, but I absolutely love it. It's a little Amazon box. So we do have governments that have been trying to take steps forward. We have governments in Switzerland and Britain. Switzerland in particular, I think, has been doing a lot of sandboxing, although they've been a little back and forth. You have experiments occurring in Singapore, a lot of them in Europe, especially Scandinavia. You've also got things where banking takes forever, super risk averse, but they're beginning to take steps forward. You have a lot of institutional capital that's beginning to take slow steps forward. And again, these are multi-year trends, and everybody's super impatient. We're all moving 7 times as fast as we should, but the trends are actually moving forward such that some of these factors are going to play out over the next few years. You also enterprise custody has been a big issue. That was one, I think, over the summer and a bit in the spring that was really hot for a lot of people. Was we as an enterprise, it'd be great if we could trade Bitcoin, but we don't even know where to store it. Things like that. It's like literally like the guts of the financial system aren't even built yet. But we're getting there, and hopefully we've cut out the scammers and we can actually get to building. So another point of context that's useful is the Gartner hype cycles. I don't know if you guys are familiar with this chart, but basically innovation kicks off, you get irrational exuberance, we don't know what the hell is going on, it hits a peak, it all kind of comes crashing down and everybody thinks it's over, and that's when the real work begins and you begin to sort of create productivity. I mean, you can look at the internet. Internet 1 followed the same thing, and it depends where you want to start in crypto. You have to be a little bit careful, which is why, again, it's useful to look back at historical narratives, because every time Bitcoin has crashed, they've sort of gone back and pointed at the chart and said, well, hey, we're about to get back up on the plateau. So you have to be a little bit careful about which narratives you choose to use. But on some level, this has played out before. So as far as use cases, this is fun stuff. Why the hell are we going to use this? That's a very unhappy looking cat, if you can't see that. So I think there are basically 2 theses about where adoption is actually going to come from. So one of them is I'll call the killer app thesis, which is basically as long as there's one app that breaks out, that's the Facebook of the new platform, or if you're looking at peer-to-peer, that's the BitTorrent or the Napster of the platform, that's going to show everyone else what you can build, and then suddenly that's going to lead the charge and everyone else is going to figure out how to iterate off of that and spread laterally, and then you have innovation, and then you have success. In a funny way, we actually kind of already have a killer app, which is Bitcoin, it's been chugging along for 10 years now, so that's one thing. There's also, again, Union Square Ventures, they've been pretty on point with a lot of their stuff. The Fat Protocol thesis, I think, was definitely missing some legs, but in general, they've been on this trend for a long time, so a lot of their research is really worth following if you're in the space. And they kind of partially rebut the killer app thesis, which is actually where this chart comes from. And they were talking about the myth of the infrastructure phase, because one of the other narratives has, of course, been, well, all we have to do is put our heads down, build a ton of infrastructure, and then once we have the infrastructure, once we have the pipes, they'll all build it up on top. That's not really how innovations typically worked. Their whole argument is that typically an app will push things beyond where the infrastructure is capable of going. They'll have to duct tape a bunch of stuff together, but the fact that they have a good business is what drives them all the way forward. And then the infrastructure sort of catches up and then the next app, pushes forward and drives it further than it should go, and then the infrastructure catches up. So it's a pretty strong rebuttal of the idea that if we just build out all this infrastructure, they're going to come. So the second one is what I call the hidden blockchain thesis. So the idea is we'll only have success when you can't actually see it. So when even the developer might not even know that they're building on a blockchain, or it's sort of abstracted to the degree that the developer has a business need, and so they choose X as opposed to Y, and X happens to be a blockchain, and nobody actually cares. So that's success really means when we don't know we're using blockchain, then maybe that's where success is. And I think these are two. Sometimes there's some overlap, sometimes there's not. Killer app is a lot sexier than hidden blockchain, but they're both well worth thinking about and considering. So another one of our favorite charts from back in the day is of course like what did the internet look like in 1993? And just to give you a sense, we're looking at the web servers. We were running on Sun servers and Mac and Windows. We were using internet traffic through FTP and Telnet and Usenet. So even though that was early stages of the internet, it wasn't clear, right? I think we can all agree that you just never know from day one. Another really good model from Benedict Evans. If you haven't seen this talk, I think it's 10-Year Futures is the name of the talk. He gives a really great description of the S-curves of innovation, and basically the idea is that every new technology roughly follows every one of these macro technological waves roughly follows it's kind of this let's call it a 4-step path, where sort of you're in this you start out in the prototyping phase where people don't really know what it's going to be used for. You're kind of testing, you're trying. It's sort of just technological hacking. And then you move into the second phase, which is the early adoption phase, which is that we have the technology, but we really have no idea what to do with it. Or on the flip side, we have a market, but we have no idea what the technology is going to do to bridge that. The third phase is where you actually move into the exponential growth. You have product market fit. And then the fourth phase is mature adoption, which actually one of his good points is that everybody in the tech community jumps off after exponential growth when the real value, the meat of the value, is actually created in the mature adoption phase. For our purposes, what's kind of interesting about this is so the way he talks about it. Again, the talk is totally worth checking out. Is PCs were one of these curves, and then mobile kind of comes in behind it, and then maybe what comes after that. But another one is that when you're in the early phase, everybody tries to just reflect the existing world in the new world. So they basically say, like, what did we think we were going to use mobile apps for when they first came out? I mean, we had like stock checkers and like the weather app and things like that, and there was no imagination. And then today, of course, we're calling Ubers on it, right? And then like you can't imagine what the delta is between these two things. And so the whole point is that step one, when we're just inching out there and we're just getting the ball rolling, like the only way that we can express ourselves is by sort of reflecting what we already know in the new technological paradigm, and that's really where we are in the blockchain space. We don't even know what could be created, and again, like can we cross that gap? Are we on an S curve, or are we on a just nothing, a speed bump? So use cases. All right, so every use case, basically there are kind of three major sets of use cases. So currencies are one, finance is another, and Web3 is another. So you could probably arbitrarily group things slightly differently, but I think this is a useful frame for looking at this. So currency is relatively straightforward. You can look at the definition of a currency. Are things a unit of account? Basically, do you if you were submitting your books, your accounting books, would you quote it in dollars or would you quote it in Bitcoins? If you're buying something, do you quote it in dollars or Bitcoins? Medium of exchange, are you actually exchanging it for goods and services? And store of value is, does it actually hold value? Are people putting it under their mattresses? Things like that. A lot of the currencies are actually kind of hitting some of these currency-like aspects. And again, one of the cool things, or one of the interesting things was, is it a currency or is it not? Is Ether a currency or is it not? If it's a currency, it means something different than if it's just a utility platform. If it's a currency, it has a $90 trillion total addressable market potentially. If it's not, then we don't. Anyways, it's a worthwhile thing to take a look at. I think currencies are currently the killer use case, but in a way less interesting because of that. So finance is the other. Finance and the development stack, I think, are sort of parallel, but worth thinking about separately. They rely on a lot of the same things. So basically the idea is, well, guess what? everybody says, oh, wow, wait, we can rebuild the whole financial system over here and sort of off to the side and disintermediate the entire existing financial system. And so some of it is doing exactly that with existing use cases like settlements and cross-border transactions and things like that. And some of it's more actually sort of self-serving in the crypto ecosystem, which is, in order to trade crypto, we must have the infrastructure to trade crypto. We must have the financial services to support that, like lending and trading on margin and derivatives and all sorts of things that sort of represent like today's financial system, but just in our little crypto world. So today, services are one of the biggest use cases. It's the picks and shovels, right? You have Coinbase, the exchange. The exchanges are some of the most profitable companies in the world in crypto, and that's basically what they're doing. You have exchanges and you have hardware companies and services companies. They're the ones who make the money here in this gold rush, and we still need banking services. So lending is another big one. So financial systems run on lending. Lending actually informs a lot of things, credit and lending. And because so many things are built on top of the fundamental nugget of understanding what your interest rate is, what your opportunity cost is. And so once we have the ability to lend, that gives us a set of tools that we can build kind of the rest of this whole finance stack on top of. So that's another use case that's in the financial side, in the finance stack, and people are working on it, and we're kind of still playing with it and innovating. So another one is tokenizing assets. So, hey, let's put your house on the blockchain, right? And I won't go too deep into it, but I will say, it does, in theory, it has the advantages of providing liquidity for illiquid assets. And, you can democratize the trading of those assets by, so you don't have to, in the very beginning, I was talking about how assets have been pooled together and aggregated and sold off. What if you could sort of chop that up into little tiny pieces and take little pieces of those? It's an interesting theory. Has a lot of challenges. So another piece of the finance stack is stablecoins. And so you hear a lot about stablecoins. They've gotten sexier over the last year or so. And the idea is that you need something stable in the crypto ecosystem to operate as a store of value, as a medium of exchange, and as a unit of account, really. The unit of account may be less important because if it's pegged to the dollar, you might as well use the dollar. But the idea is there are multiple types of stable coins, and they all have problems. It's a very difficult problem to solve. And I won't go into the details here. You can look into it, but I just kind of wanted to highlight that as again, like a fundamental nugget in our finance stack that needs to be figured out. So what actually are sort of the fundamental primitives that we actually have now that we didn't have before in the blockchain world? So I think two of the big ones are accounts and payments. So accounts are something that are actually native to the blockchain world, and it means that you don't have to own the account. The account natively lives on the blockchain, and so suddenly you're separated from this idea of the account. Accounts can be almost an autonomous thing. Even programs can actually have their own accounts. Cars can have their own accounts. Refrigerators can have their own accounts, and suddenly it frees this world where anyone has actually autonomy over their money. And then on the payment side, now we also have the ability to rapidly and immediately settle payments. We have, and that also with lower cost structures gives us the ability to do micropayments. And when you combine those two things, you have some interesting new worlds where, for instance, like Internet of Things devices can have their own wallets and can do their own transactions completely autonomously from you. And you can even imagine a world where there are autonomous vehicles that are owned by some fleet that kind of have their own accounts that sort of take care of their things and come back and it's maybe that's just still on that early phase where we're trying to reflect today's world in the new one, but it's kind of cool to have these new primitives, and we'll talk about primitives as well in the Web3. So the future, well, obviously ICOs have really been kind of a stub toe for everyone. We definitely need a lot more institutional tools, and we need more of sort of those fundamental finance nuggets, which are still lending, credit. Obviously asset tokenization has plenty of stuff there too, but there's a pretty cool future there. So people are obviously going to keep working on this, regardless of what the price is right now. So the one that personally I'm most interested in is the Web3 side, and I think a lot of the smart the noise around the smart contract platforms is also obviously around Web3. And so the idea here is that you re-decentralize the web. It's kind of a fun narrative because obviously it was meant to be decentralized from the beginning, something. I won't get too invested in the soapbox there, but What's kind of cool about basically you're sort of crossing this hybrid of sort of the Amazon Web Services that runs the web with the unkillability of Bitcoin, and then you have this decentralized web, which can do some really cool stuff. Like, your app is no longer censorable because once it's launched, it's out there. You can't even change it. It's also transparent because the code is open source. If it's not open source, it's open to someone because they're running it. It's at least open binary, and you can reverse engineer things. So it's kind of pointless not to open source. And it's also forkable. So for instance, this is actually a pro and a con, because one of the challenges is that how do you create a business model that allows you to actually extract real economic value from an app that you've created if somebody can just copy it, remove your ability to take money out of it, and redeploy it. So there are kind of three things that this gives you back, which is kind of what's exciting about it. Is it gives you back control over your money, it gives you back control over your data, and it gives you back control over your identity. And that again, thinking back to those original macro forces, that's kind of the whole point. Or not the whole point necessarily of the technology, but kind of the reason why so many people are excited about this. One of the key challenges is, do users really want this? And again, I'll keep banging that drum because I don't want to be. I am personally a skeptic, and I want to be careful about presenting a one-sided narrative when in fact it is very definitely a two-sided narrative. But so talking about primitives, we're talking about finance primitives. You got accounts and you got transactions. So primitives that we have now on the web side are, we have portability, right? So you can if you have an asset that comes out of a video game, you can now take it, like you own it, and you can take it and you can walk away with it and you can drop it into another game. I mean, that's kind of a silly toy example, but it gives you a sense of what portability means. And you don't need permission. So cryptographic primitives are actually quite significant. You can verify almost anything because you have so much easy access to the cryptography that underlies the blockchain. You can say, did something happen? Does somebody have something? Is this mine? Was this my transaction? Did this company post this thing at this time? And that actually creates a lot of value in the world that demands transparency. Again, accounts specifically on this web mean that you have an account that can actually hold your identity. So your identity is also kind of a native thing because it's tied to the account. And then finally, peer-to-peer, sort of the ability to permissionlessly interact. So again, you don't need permission. Again, I'll use the silly example of, like, I have a sword from a game. I don't need the permission of the game creator to give you that sword. You and I can transact over here. The central entity has no idea what's going on, and that's actually very powerful. But currently, what have we applied that for? What do you expect? I don't think we've gotten porn on there, but not for lack of trying. It's gambling exchanges and gaming, and not that many users at that. There are also other interesting use cases. I'm not going to dive too deep into them, but I also don't want to make it seem like all we're trying to do is rebuild apps. There's a lot of other stuff that takes place in the web stack, right? Just a few examples. LivePeer is a company that they do sort of crowdsourced video transcoding. You've got distributed commodity computing. So for people who need to do machine learning across large numbers of computers, and you have some spare capacity in your iPhone, in theory, you could distribute that over a wide network. You also have file storage. Again, you have spare space in your hard drive. It's almost like the digital extension of the sharing economy, right? Where you're kind of sharing your digital assets as well. And so there's a lot of cool stuff that you can do with those ideas that we're still surfacing. So just want to quickly mention, since this is an overview, obviously not even all chains are the same. There are public blockchains, there are private blockchains, and public chains are like Ethereum. Everybody can see everything that's going on the chain. Public doesn't necessarily mean not private. What do I want to say? Public doesn't mean that your data is exposed completely, because you can still use cryptography to encrypt it. But the question, the sort of unanswered question is that sufficient? Is that sufficient to say my data is unavailable to anyone, or is it only saying my data is unavailable to anyone for the next 8.5 years until they figure out how to break that encryption? So open questions there. Private chains are kind of the enterprise solution, where of course enterprises want to control their data. They don't even want to take those risks. So they say, hey, why don't you take a blockchain and you just run all the nodes on this blockchain yourselves? And you can do the same thing with a consortium of companies that are collaborating. So I could dive a little bit more into private chains as well. It's kind of like, why would you use a blockchain? But I'll let IBM answer that for their many, many clients. All right, so what are the challenges that we have? Specifically, I want to focus on the DApp side, just because, again, that's kind of my axe to grind, and it's also cool. So these problems are really designed to be your opportunities, right? So one of the points of this is to surface ways that we need help, and so I think you've probably seen a lot of them implicitly. One of the ones that we have right here is that user experience sucks on all levels of the user's journey. From what does it take to actually enter the crypto ecosystem? Like how many steps does it take for me to actually go and buy cryptocurrency and then come in and figure out how the hell do I use this to interact with an app that's asking me to use this? And, you know, it means that I have to do a bunch of things. It also means I have to know a bunch of things. It means I have to look at windows that are telling me with like big bold font, like I can't lose my private key. And I'm like, what the hell is a private key? You know, what is a wallet? Why do I have to learn all of these things just to use something? And so this is why you have a 97% drop off from you know, first user trying something to actually completing it. And then, you know, you have stories like, you know, there are no protections for things like I forgot my I forgot my private key and I lost X amount of Bitcoin, which is a not uncommon thing. The other side is that developer experience also sucks. And we're talking about this next week in our meetup and doing a deep dive on developer experience. But developers are building this whole ecosystem, right? Maybe not the entire thing, but like they're a pretty important component of all of this, right? And their experience is also terrible. We had our whole team go out to the Ethereum hackathon and try out the Ethereum tools. And, you know, it was very clear the tools are all made by completely different people. It requires you to, you know, there's not a lot of education. There's not a lot of support when you have errors. Some things are up on Stack Overflow, but that's from the wrong version. You know, it's the Wild West out there trying to figure out how do you cobble all this crap together and actually build something with it. And so if you were to sort of survey developers of you know, like what is the time between first clicking on the website and then having a deployed project, it would be atrociously long and complicated. So obviously I think we've all heard of the scaling problem, and you know the key example is what happened when CryptoKitties went crazy last year, at the end of last year. And a bunch of people decided that was going to be the hot new app, and it was going to break out, and it was going to, you know, that was the killer app. We finally found it. Well, the problem is when a bunch of people started using it on a network that can only handle 14 transactions a second, the network gums up, and then congestion comes in, and then, you know, I'll talk about cost in a second, but costs go through the roof. So this is a chart of pending transactions. So this means that these are the number of transactions that are waiting their turn to get put in a block. And they went from, you know, plus or minus, call it 500 or, you know, several hundred up to almost 20,000 over the course of what was going on there. And of course, that's a terrible experience, because if you think that, you know, imagine trying to use this for paying for something, and you're standing there with your buddy and you're just tapping your foot and you're waiting for your transaction to go through for who knows how long it takes to go through 20,000 transactions. Not a good experience. So there's a new wave of platforms coming out and that have come out that have made a lot of promises, but this is still very top of mind because this was a visceral experience for the whole community, because not only was CryptoKitties slow, but everybody else was slow, because it's like a shared hosting problem. So on the solution side, this is another path where there have been multiple narratives. The first one was, it doesn't matter if Bitcoin scales, like we'll figure it out. We're developers, we've got this. And it turns out that the Bitcoin core development team doesn't really want to move too fast. They don't really want to break too much, and they don't really have a lot of incentive to. I mean, Bitcoin is designed to do one thing very, very well, and it does that thing very, very well. They don't need to necessarily go out of their way to break what works well in order to figure out how to scale it. So what they said was, all right, we'll just push this. We'll use Bitcoin on the bottom, and we'll push this up to layer 2 is what they call it, right? And so what that means is we're gonna do as much energy and computation and transactions off the main chain, and we're going to come up with whether it's side chains, or we're going to connect two people directly with state channels, and we're going to have them do all that stuff off chain, and then when we're done with that, we'll benchmark it back on the main chain, stuff like that, which actually sounds like a great idea, except in practice it's been very complicated. It's been hard to implement technologically, and the user experience of trying to create that for your app hasn't been very good. So there's been some disillusionment with layer 2 as well, where we're starting to return back to this narrative of, well, actually maybe we should be scaling from layer 1 at the very bottom. And so that's where there are kind of two types of approaches. One is, can we make layer 1 much faster by just having better hardware? And essentially like that becomes a centralizing force. And so, someone like EOS, they've gone out and said, well, actually, so maybe we don't need 15,000 or 150,000 nodes. Why don't we just take 21 nodes and make them really good? And so that's kind of been their approach on one side, is sort of quasi re-centralizing things. And then on the other side, you have sharding approaches, which is something that we do at Near, and it's something that Ethereum is trying to come out with. And there are a few other players who are doing it as well, which is much more of, let's keep this as decentralized as possible, and let's break it up into tiny pieces and use them all in parallel. So that's kind of where the arc is pushing right now. Obviously, from our driver's seat, we're somewhat biased as to where that should go, but that should at least give you some context of like how we've tried to solve this problem, and that it is definitely an unsolved problem as of today. So the cost is the other problem, which is, of course, if you're trying to build a business on top of things and your costs are completely unknown, and they've gone from 10 cents all the way up to what do we? I don't even remember how high they went. Well, so on the Bitcoin side, you go from something like, what is it, 50 cents all the way up to $60 per transaction. I mean, like you can't have that kind of variability in your app, right? Like, how do you build a business on something that has that level of variability? Like, in order to do that, you're basically you're like a commodities business that, like a copper miner that has to hedge the price of copper, meaning you would have to sort of figure out like a futures market to offset your risk. It just doesn't make any sense, right? So we're just not there on the cost side. If you want to create viable businesses, you have to understand what your reliability is going to look like and what your costs are going to look like. And speaking of businesses, I mean, business models are another thing that are a serious problem. Meaning that we thought ICOs were the business model that was going to work, right? Because we finally said, hey, there's a way for developers to actually make money at this stuff. And it turns out, well, that didn't work out too well. Most of the coins were just roadblocks in front of users that were attempting to extract rent, or they just didn't. There wasn't really a lot of reason to have those tokens. And so that whole system kind of went by the wayside. And so what do we have now? I mean, to be frankly honest, most of the apps that are out there are being supported by venture capital that's been sort of invested in the system that hasn't yet found a viable business model, other than on the financial side, the picks and shovels businesses. So it's like there's kind of this breathe in of capital that's coming in, that's kind of supporting things. You have ecosystem funds from a lot of these networks that are funding businesses and DApps that are being created on their networks. But until those have independent business models that allow those entrepreneurs to go out there and make their own money, like, this is not sustainable. And not only that, but it's more difficult in this space to actually use some of our existing business models. For instance, how do you build a SaaS app when you, like I was saying before, when somebody could literally just take your contract and fork out the way that you were bringing money from that contract, and your contract is your app, right? So and how do you do a monthly subscription if your costs look like this, and is that $7 a month? How do you allocate that $7 a month? It's stuff like that. It's more difficult to do on this space. So these are some of the warts that we're really trying to figure out right now. Because unless fundamentally, like, you can't build a business unless you give people a way to make money. It just doesn't work. So this is I think one of the under-addressed problems that absolutely has to be addressed. Otherwise, this whole thing is the air is gonna go right out of it when the capital dries up. All right, another one, education. So this happens in all new markets, but right now, the incentives are out there. If you're a great developer and you're good at the stuff, you build because there's still capital flowing into the system, and it's on the cutting edge, and you're doing cool stuff. And so that's just what happens in new markets. Is people go out there and they build stuff, and then we get the next wave behind them are the people who are maybe not quite on the bleeding edge, but they've got one foot there, and they're blogging about it, and you've got docs that are being written kind of like not really that well curated, and like that's kind of the best institutional knowledge that we have right now. And then it's only when you get to step 3, which is when actually there are jobs being created in the space, does that create the incentive for people to begin to educate, for students to bother spending 3 months, 6 months, or whatever it takes to educate themselves up, because they know that there's actually a return on that investment of their time. And on the same time, there's an incentive to teach. There's an incentive to pay teachers because students are willing to pay them. So there's a little bit of chicken and egg going on, but the way that markets tend to develop is you have an education vacuum. And this is definitely where we are now. And of course, this is part of the reason why we're here. So one of those big sort of challenging problems psychologically, when you have a bad day, you wake up and you say, well, we're trying our damnedest to give people control, as much control as possible. We're going to give you your identity back. We're going to give you your data back. We're going to give you your money back. It's going to be the best. And then you just go and drop it into Coinbase and give them control. And then we've de-decentralized the web once again. And that's a serious challenge. And I don't, a lot of that comes down to a user experience challenge. And so, circle back to the UX issues and the DevX issues, but it's something that can be really disheartening and is also really challenging. And we have to figure out, how do we balance this? How do we balance this natural human tendency to not want to think about stuff and to give it to other people with the benefits of doing that, which goes all the way back to what I was talking about, which is you have to provide them with clear incentive for them, short-term incentive for them to actually decentralize. Otherwise, it's just not worth their time. Or if they were thinking rationally and doing some sort of structured analysis, maybe it would be, but nobody does that. These are humans. So another one that's definitely worth mentioning is diversity and inclusion. This is a space that isn't, it's not terribly diverse. And I'm not just talking about skin, right? Function is super important. And I was talking about this a little bit at the beginning, but it's not about developers only. It's about an ecosystem, a three-dimensional ecosystem, and we're not doing a very good job right now of welcoming other people into this ecosystem, welcoming their voices, and also giving them an on-ramp that isn't about throwing a bunch of technical crap at them right from day one. Another one is also industry experience. As with a lot of early tech industries, you have a lot of very young and inexperienced people who are great at coming up with creative solutions, but aren't necessarily drawing on best practices that have been crafted through years of industry experience. So that's one thing to be careful of. And of course, gender is always a tech problem, and I think it's exacerbated in blockchain specifically. But at least there's geographical diversity. So just a quick bit on where does that go from here. So all you have to do is fix all the problems. So user experience and developer experience, that's, there are a lot of people in the product world and the design world who are perfect fits for starting to figure these problems out. We have to build out the ecosystem, so if you could find the killer app, that would be awesome. We have scaling challenges, which is a lot of what we're trying to address, although we're sort of trying to take it on as much as we can. And then there's a lot of things that we just don't have good models for. I talked about valuation. So much of what has driven the path of this market has actually been a lack of ability to properly understand, how do we value these things? What is it worth if you win as the world's best distributed computing platform? Is that a $1 million business or a $1 trillion business? We don't even know. We have experiments in governance. How do you, if something's completely decentralized, how do you actually operate that as like a tech company would, where you can upgrade the system, you can future-proof it, you can if there's another platform that's getting better, that's moving faster, like how do you continue to innovate? Well, you have to sort of, does that mean you poll everybody on the system and you say, hey, can we get your permission to push a software upgrade? Or what does that look like? So governance is actually a hugely important thing that really in a lot of ways is going to determine the future of a lot of these platforms. And I think that's something that we've seen historically, the different platforms that have different governance strategies. Like Bitcoin has a very sort of, let's call it change resistant type of infrastructure. And then you have Ethereum, which has, again, something that's not quite moving as fast as a lot would like. There's a lot of chaos in the system. I don't think we've yet found an example of somebody who's innovating too quickly, but you do have a lot of teams that are maybe a little too centralized, and there's a lot of concern. Like Ethereum also, there are concerns around the centralization of its team. So governance, do you give all the power to the core developers? If Vitalik says we should do a thing, like the DAO hack, if he sort of comes out on one side and says we should resolve this hack by giving everyone their money back or not, how much sway does that have? These are actually really important questions that we don't have a lot of test beds for. Things also like consensus models, proof of work is very well understood after 10 years now, but proof of stake is just coming out and everybody's using proof of stake going forward. It's not the only one, but we have a lot of things that need to be figured out. So there's a lot of sort of academic work. There's modeling work. There's a lot around business side. There's a lot of competitive analysis. Like how is this market going to develop strategically? What does it take to win? So it's almost like it doesn't matter what your background is. There is a way for you to find a problem because we have lots of them. So I think really the pitch is. Is if you solve one of these problems, you could be the catalyst to actually take this into the next phase. And that's pretty cool. Like that's part of the fun of working on an emerging technology. is that you can be a part of that process. And there's so much green field and there's so much space. And the people who are working on these problems, nobody has it figured out, so everybody needs help. So we're all talking to each other, and it's a community that's really supportive of that. So it's a lot of fun. So if you want to start, to kind of leave you with something that's tangible, but like, all you have to do is you figure out who do you follow. You have to learn the tech. It's a tech-driven market. You don't have to read every single white paper that's out there. That's totally overkill. But you have to be comfortable with the technical language. Find a problem that actually motivates you, that fits your skills. There's probably 12 blog posts about it, and that's it. And then you'll drop off a cliff. Try researching blockchain user experience and design and things like that. You get to the edge of the world very quickly. How do we value cryptocurrencies? You get to the edge of the world very quickly. So it might seem like we have it figured out because some smart person got 5,000 claps on Medium, but there's not a lot. I mean, there's so much more that needs to be done. And help out wherever you can, right? We're all here, we're all builders, we're all makers. You guys are motivated to come out outside of work hours, and I think that's not too hard for you. And if you can, figure out how to hire yourself in, because a lot of these are skill sets that need to be done. Like if you're a marketer, a lot of these companies need to figure out how they actually cross the gap and reach real users. That's a hugely important skill that isn't really well talked about. There's a lot of this stuff. And then finally, please write about it. Teach, add to the collective wisdom. I won't make you a pitch about being a thought leader because that has some negative connotations out there. But I mean, really, anything that you add, you become a thought leader, just by virtue of adding to our collective knowledge. So, thanks for taking the time to learn, and I hope you guys can go out there and do some good.